comrades. The context of this video is to help prepare students for questions where they're asked to describe transactions from either a completed inventory ledger or an inventory card. And this is a classic application knowledge question because normally we would get a list of transactions or a bunch of source documents, and then we would record that information into a general journal, general ledger, inventory card, rather than working the opposite way. So again, we need to kind of think in reverse here. So let's just verbally go through these 13 possibilities in our inventory ledger. And just a reminder, in terms of our rules of double entry, anything on our debit side here is going to increase our inventory. Anything on our credit side is going to reduce our inventory, given inventory is an asset. So entry number one, balance. That's when we're asked to describe that, that's simply the balance remaining from the previous period, which is carried forward to the current period, our current balance of inventory. Now, number two, our cross-reference is bank. So when asked to describe what type of transaction led to this entry, you would simply mention a couple of things. It's a cash purchase of inventory. Third one here, accounts payable. So again, we're on the debit side here. We're increasing our inventory. So what's led to this entry? This time it's a credit purchase of inventory. We must emphasize that it's credit and also the purchase aspect of it. Number four is the type of entry that will typically stump students, because when we have a cost of sales, we tend to see that on the credit side, but this one is on the debit side. So we need to ask ourselves what's led to this entry. Well, what's led to it is a sales return. So when you're describing this transaction, you would say it's a sales return of inventory recorded at the cost price. Number five, fairly self-explanatory. We've done a physical stock take and it's revealed an inventory gain, possibly due to an oversupply from the supplier or an undersupply to a customer. Now, when we look at number six and number seven here, the reason I've replicated these is just to help students be mindful of the fact that we can have a cost of sales from a cash sale, and we can also have a cost of sale from a credit sale of inventory. Number eight, again, we've done a physical stock take and it's revealed that our count is less than what we have in our card, so therefore we do need to do an adjustment for the inventory loss. Number nine, in terms of advertising, so that entry would be the result of a donation of inventory to some type of approved charity. So there's a goodwill benefit, but we classify it as an expense in terms of a debit to advertising and a credit to inventory. Drawings, when you're describing that, the owner has withdrawn inventory for personal use. Accounts payable, again, this is a trap, this one, because when we have an accounts payable entry on the debit side, that's from a credit purchase. So therefore, number 11 would be a purchase return. When we've got some faulty inventory, let's say, and we've returned it and been issued with a credit note, so therefore that decreases our account payable liability and decreases our inventory on hand. Number 12, an inventory write-down, which occurs when the lower of cost or NRV rule comes into play. So if our NRV is lower than cost, we record an inventory write-down to satisfy the accrual basis assumption, recognise a loss when it's anticipated. And number 13 is the final balance on hand, which should match the balance in our inventory cards. Now, same principle when you have an inventory card. Again, in the in column, anything in the in column will increase our inventory on hand. So think about the debit side of that inventory ledger we just looked at. So these are all going to be debits, and the out, these are all going to be credits. So let's have a look at this first one. The invoice on the third, we're in the out column. So this is reducing inventory. So the source document invoice would be for a credit sale of inventory. So again, we need to emphasize the fact that this is a credit sale of inventory. Then on the 4th, we've got a credit note. So this credit note means that some of this inventory that we purchased the day before has been returned. So again, when you're asked to describe the transaction on the 4th here, we'd say it's a sales return, and we've recorded the cost price effect of that sales return because the inventory is coming back into the business. Now, this memo here on the 7th, this one's a little bit interesting because there's a few possibilities here. So we've got it's in the out column. So we need to think about the credit side of that inventory ledger we just looked at. What are some of the possibilities here? Well, it could be advertising because we've donated some inventory to a charity, or it could be drawings. It could possibly be an inventory loss if we did a physical stock take on the 7th. Now, that's unlikely that we do it during the month. So therefore, you can go with a couple of possibilities. You wouldn't need to specify both, but you could say it's advertising of inventory, or it's drawings of inventory the owner has taken out inventory for personal use. So the recurring theme here is we always need to mention that it's inventory. Anything in the in column, we're going to mention that increases the inventory. Anything in the out column has decreased it. Then we get to the 10th, and again, we've got an invoice here, but this time we're in the in column. So therefore, we've got a credit purchase of inventory. So emphasis on the fact that when we have an invoice, it's credit. If it's on the in column, it's a purchase. Out column, it's a sale. And then again, on the 12th, we've got a credit note. So therefore, we'd assume that credit note relates to the purchase we had on the 10th. So therefore, that's a bit of a clue that this is a purchase return of inventory. So again, we purchased some inventory on the 10th, wrong size, wrong color, it's damaged, and we've returned it, hence it's in the out column. So we need to emphasize it's a purchase return. Then on the 16th, we've got a receipt in the out column. So this is simply a cash sale of inventory as evidenced by the receipt, and we've recorded the cost price effect of that. Then we get to the an in on the 20th. It's an EFT. So the fact that it's EFT means it's a cash transaction. The fact that it's in the in column means we've bought it for cash. So this is a cash purchase of inventory. Then on the 24th, invoice, again in the out column, the FIFO rules in play here. So this is a credit sale of inventory. We've got another memo on the 25th in the out column. So again, that could be advertising of inventory. We've donated it to a charity, or drawings. And then finally on the 31st, we've got an in of 3 units, a memo, a couple of clues here. Number 1, it's at the end of the month, 31 days in October. Number 2, we've got a memo, so therefore it's a non-trading entry. So therefore, this is an indication that this is an inventory gain. So therefore, we've done a physical stock take, and our count reveals that we've got more than our card. So we've topped up our inventory card with an inventory gain. So when describing that, you'd mention that Memo 54 represents the recording of an inventory gain revealed by a physical stock take.